Welcome to Financial Clinic, your ultimate guide to achieving financial success. Proudly sponsored by NCBA Bank. Join Sally Limo as she expertly shares invaluable tips and insights designed to empower you in reaching both your personal, business, and financial goals with NCBA Bank. Your journey to a brighter financial future starts here.
NCBA. Go for it.
My name is Gicheru from NCBA Investment Bank, where I lead the asset management team. My role is the Chief Investment Officer. Bonds will be ownership of debt investments that are issued by either corporate institutions or issued by government institutions. So what we are doing is entered into an agreement with the government of Kenya, for example, to lend them money, and in return they pay you interest, and when your money matures, they give the money back to you. On the other hand, equities is actually ownership in companies. So when you're investing in equities, you're taking a proportionate ownership in the shares of listed companies by and large, just as you would, for example, owning your own business. But what listed equities do is to help you give the opportunity to actually buy and sell and hold for a short period of time and can pass on the ownership to someone else. There are many types of bonds in the market. So the most known are government bonds, and they come in two forms, especially in Kenya. You have what we call taxable treasury bonds. These are bonds that are issued. They pay interest every 6 months, but that interest is subjected to tax. We have another category called infrastructure bonds. Those are bonds issued by the same government. The interest earned on these bonds are not subjected to taxes. They are corporate bonds. These are issued by individual companies that are trying to raise capital, and they normally issue bonds for anywhere between 5 and maybe 10 years. And those bonds could actually be what we call amortizing. Amortizing means a bond is paid down over time, or they could be bonds that we say pay at the end of the period. So if it's a 5 years borrowing, you'll only get your principal back after 5 years, and those ones are called bullet bonds. The biggest benefit you get by investing through NCBA is actually professional advice, so that we walk through the journey with you in terms of analyzing investments, understanding the risks and returns of those investments, and actually administering those investments for you. The other thing is actually providing access into a range of investments because of a wide array of customers and and markets that you're accessing. Then you're able to access bonds that you may not typically access if you're doing it on your own. So we're able to give you that diversity of of investments that you can actually use in terms of creating your own portfolio. So a bond portfolio, in essence, can be created such that by the time you're retiring, it's going to be paying you interest over time that replaces that that income. And so the advice here is to actually look for a range of bonds that can actually, in total terms, give you the income that you'll be looking for. That income can be paid to you every month, or can be paid every 6 months or quarterly, depending on what you go for. Equities, on the other hand, are instruments that you'd want to use early in your retirement planning cycle, because the idea with equities is that over time, the value of the assets that you've bought are actually growing, and you're also earning dividends. So you don't use equities very late in your retirement plan. You actually start doing it early. But as you get it closer to retirement, you probably want to transition a bulk of your equity investments into bond structures. And then you also get a relationship manager who works with you through the journey, so that in case you need help on any item, then you have someone to actually handhold you in that process. So I welcome you to join me on the Financial Clinic to learn more about investing in equities and bonds. Most welcome.
Twende mbele. NCBA. Go for it.
Beautiful Wednesday morning as Wednesday for creating wealth, and we're doing this time with NCBA, who are partnering with us to bring you this financial show where we are ready to help you navigate your financial journey, do everything that pertains to money matters in a very guided way, if I can say so. And this morning, I may just want to urge you and welcome you into this very special session or season of Financial Clinic, where we'll be talking about bonds and equity. What do you need to know about this? Or what do you know about bonds and equity? Have you invested in that? Do you know that you can actually create wealth through bonds and equity? So with me is an expert in money matters, and especially bonds and equities, an expert from NCBA Bank who is going to take us through that. And please join in on the conversation. SMS line is 20316. WhatsApp us on 0786 316 316 and get to be part of this amazing and insightful conversation. Karibu sana Paul. Please introduce yourself to our audience.
Thank you so much, and good morning, Sally.
Good morning.
I really appreciate the opportunity to actually join your show this morning. Yeah. Just to introduce myself, my name is Paul Gicheru. I work at NCBA Investment Bank. NCBA Investment Bank is a company owned by the NCBA Group, and we provide a range of services within NCBA Investment Bank, including corporate finance advisory. And in this type of service, we offer solutions to corporates who are seeking to raise finances, corporates seeking to get listed on the stock exchanges, companies that are going through restructuring, and any other range of solutions that institutions may be looking for. We also do have a brokerage business, which is a business that helps customers to access investment solutions across the markets. And so if you're looking, for example, to buy stocks on the Nairobi Securities Exchange, you're buying or selling bonds on the market, then our brokerage business assists in that. And then that line of service we have is what we call asset management or wealth management, as we like to call it. Wealth management is where we actually develop tailored solutions for our customers. And the idea here being, we do appreciate that every customer has their own unique needs as far as investing is concerned. And so when you come to us, then we try to listen to your story, and then collectively with you, we develop solutions that fit for purpose. So that's the range of service we offer, and I think over time we've assisted customers to actually realize their wealth development journeys. Thank you.
I really like your intro, because you've talked about solutions and wealth, and I think that's what really people are looking for when it comes to money matters. And therefore, for someone out there who's watching, probably a potential investor, then what are bonds and equities? What is that all about?
Thank you. So just to describe what bonds are, so bonds are generic contracts that companies or institutions that are looking for finances issue. And the idea is that there will be a collection of investors who are willing, for example, to lend to a company. And so a bond contract is a contract whereby then the company is committing that in exchange for you financing my activities, then I'll pay you interest. And at the end of the period for which I'm looking for this financing, I'll pay you back your capital. So as the word suggests, we're actually bonding each other to actually, you give me your money, in return I'll give you interest as a source of return for actually using your money to do my investment projects. Equities, on the other hand, is actually the value of your own investment in a company. So just as we do business, you actually put in some money so that you can grow your business. So equity in the wider sense, as far as financial markets are concerned, describes that stake that you have in a company. So if, for example, today I chose to buy a share of, let's use an example of Safaricom, for example, then I'm an equity investor in Safaricom. So my equity is that proportionate ownership I have in the company. Yeah.
Well, and so are there different types of bonds that someone may venture into?
Indeed, there's a wide range of bonds opportunities. What I'll do, let me just describe probably what is available in Kenya at this point in time, because there are wide variations of these types of instruments. So in Kenya, the most known bonds are bonds issued by the government, and the government of Kenya through Central Bank issues two types of bonds predominantly. They issue what we call taxable treasury bonds. So taxable treasury bonds in this case are bonds that will pay interest every 6 months. Their tenor range from as short as 2 years, and I think the longest we've probably seen in this market is up to 30 years. And what these bonds do is to pay you interest every 6 months, and that interest is subjected to tax. Of course, the tax ranges from 10% all the way to 15%, depending on the type of bond you're buying. Then there's a second category called infrastructure bonds. Infrastructure bonds, by their nature, are supposed to finance infrastructure projects, in the economy. And so, what the government does is to issue this type of bonds, but to make them more attractive, they actually make them tax-free. So, interest income earned from infrastructure bonds is actually tax-free. The other type of bonds that you get in this market is corporate bonds. These are issued by, good credit quality corporates that are seeking to raise finances. And in Kenya, the range or the period over which you've seen these bonds being issued is anywhere between 5 and 10 years. They pay interest. Again, most of them will pay 6 months, although you see some pay on a quarterly basis. They're also subject to tax, and so every time you're seeking these opportunities, you also have to evaluate the tax implication of on the return that you're earning.
Yeah, because actually I was coming to that. What are some of the tax incentives, that may just appeal to a potential investor, apart from the tax-free aspect of it? So what other tax incentives are there? Yeah.
Now, as I said, interest income, for example, for the infrastructure bonds is actually tax-free. But what you also realize, if you actually traded a bond in the market and made a gain, that gain is not subjected to tax. If, for example, you are trading that bond in the market. And so you get a good tax planning opportunity by buying some of these investments and realizing returns out of them over time. And then, of course, there's a potential allowability. The tax, for example, that accrues on a taxable bond can be offset against your corporate tax, at a later date in time. Because if you're investing as a corporate, then your total tax will be 30%, but you've already paid a 15% tax on a bond that is actually offset. If you buy infrastructure bond as a corporate, then that line of income is actually not subjected to taxes. So there's actually a tax advantage of investing in these bond instruments in the market.
Yeah, and as the investor now is there already, what are some of the things that could go wrong, and what are how do you manage such risks? Yeah.
So indeed, and I think we can look at bonds first and then jump onto equities.
Yeah.
So as I said, a bond contract, you're actually lending money to an institution. So one thing that is very important to consider ever is the credit worthiness of the institution to which you're lending this money, because being a passive income, passive investment, then what you're trying to make sure is that if I invest my money in this company, then the risk of loss of that money is actually moderated. And so what could go wrong really is in the form of default. If, for example, the company you're investing in then defaults in payment, then you're actually saying you are at the risk of losing your principal investment. So as part of the investment process, one thing that you have to always consider is how creditworthy is the borrower as far as is concerned. Then the second type of risk that we always see, or things that could go wrong with this investment, is if at times you misalign, your investment objective versus the investment you are buying, then you can find yourself in situations where, for example, you need money but you cannot access it. And case in point is, if, for example, I invested school fees that I'll be paying for my kids next month and bought a bond, the presumption is that I'll go to the market, I'll sell that bond and I'll get my money back. But market is subject to cycles. So at times you think you have a good investment, but you can't access your money. So it's always important then to ensure that as you're buying these investments, they actually align to the objective that you're actually pursuing. So, but I think the most important one for me is always the credit worthiness of the company, just so that you avoid the risk of default. When it comes to equities, equities actually are like the residual risk that people take in a company. So that if a company goes down, or as you say, goes bust, then unfortunately you actually lose your money. So one important thing one always have to consider is, fundamentally, is the company I'm investing in solid enough so that I can be confident that my investment will actually grow, that this company can actually be able to pay dividends, that this company is actually growing and meeting the objectives. Because remember, the end point of investing in stocks is actually to earn that dividend income and over time get a capital appreciation for that investment. So if you don't realize those two objectives, and those things could actually, those two things could actually go wrong. And then obviously, even for the equities market, the risk that the market could actually be down when you're trying to dispose an equity security.
So here I'm an investor. I want to invest. Does NCBA have investment accounts and probably also advisory services for someone like me? Now I'm coming in as an investor.
Great, good question. Yes, indeed. I think I started by introducing NCBA Investment Bank. Yes, we do provide a lot of advice around investing.
Yeah.
So if you're seeking to buy a bond or invest in equity securities, then you can always approach NCBA Investment Bank. There are different ways that we can actually help you on this. So the first one would be, as I said, you have a brokerage business. So if you actually want to run these investments by yourself, then you can set up, if it's for bonds, you can actually set up a CDS account with Central Bank, and with that CDS account, then you can actually get our brokerage business to source bonds and and put them on your CDS account. And if you want to sell them, then you can also use the services of our brokerage business to actually sell those securities. The same applies for equities. If you wanted to buy and sell and manage that equity portfolio on your own, then our brokerage business can actually assist in that. On top of that, then on the wealth management side or the asset management side, we can actually run those portfolios on your behalf. So what we'll do is that you come to us, we agree on an objective of an investment, and then we collectively agree on what type of investments we are going for. And through our custody account, we buy those investments and continue managing those investments on your behalf. So that then every so often, maybe on a quarterly basis, we are sitting to discuss and evaluating whether these investments are still meeting the objectives. So one way would be to do it by yourself. The other way is to do it through a managed portfolio. And even, for example, where you still want to do it yourself, but you don't want to go the whole leg of opening CDS accounts, you actually have custody accounts through which you can actually access these investments. I think something to add also is more recently, I think we've seen Central Bank enable investors the more by creating what we call CSDAO accounts. CSD accounts rather, where you can actually digitally set up your own account. Now, what you realize that even with that, you still need a broker to actually take those transactions to the market. So NCBA actually also places themselves in that position to actually provide that broking solution, so that if you want to sell those bonds or you want to buy more from the secondary market, then you can actually offer that as well. And just to add also, if you are the type that also says, I don't have the time to actually evaluate stocks, I don't have the time to evaluate bond securities, then we actually can provide indirect investments through funds. So we have a fund, for example, that buys listed stocks in the Kenyan market, listed stocks in the global markets. We also have a fund that also buys bonds in the local market and also in the foreign markets. So that you can actually come to us and say, I want exposure to bonds, can I buy into these funds? And then based on your objectives, we can actually advise which type of funds or allocation you can actually do to these investments.
You've mentioned technology somewhere. So what role does technology play in all this? Is it that important?
Indeed. Yes, technology is a very important enabler as far as investing is concerned. And I think where we are, it makes it more efficient to actually access these investments. So you can imagine sitting in the comfort of your living room, that you're able to pull investments from different sources just through your phone. And so with that, you're able to create diversified investments, pulling from different sources through just an application. So it's a very important enabler. Then technology is going an extra bit, where it's providing platforms for advice, so that you can go in and model your investments, and then you'll probably be able to evaluate the kind of risk framework that you actually get. And from there, you can say, this is how I feel my investment. With technology also, you can actually do your own risk assessment. This is assessing your capacity to take risks and deciding, if my risk assessment shows me to be very conservative, what investments then can I actually go for? So it's a very major enabler as far as investing is concerned, and it's making life much easier for all of us in terms of deciding how to create our portfolios and manage those portfolios.
So as a customer and an investor, do you go through your website? Is it on, what tools are there?
So within NCBA, if you're looking to buy shares, on the stock exchange, we have an application called online trading that you can actually enroll onto and are able to actually access the stock market and are able to buy and sell shares. On the asset management side, we have an application we call Invest Now. Invest Now then allows you to actually buy the range of investments that you're offering within the NCBA Investment Bank. Of course, we're still developing our digital capability, and we're adding more solutions with the hope that eventually we'll actually have a full-blown solution that allows you to even construct portfolios, evaluate those portfolios, and keep tracking the kind of risks that come with those investments.
Okay, we've talked about all this, but then again, I think there's a very important point people need to know, or, from NCBA, what are the steps if I want to now buy the bonds and equities? What are the steps?
Great.
Yeah.
Good question. So within NCBA, if you wanted to, and I do encourage you to actually try NCBA, if you wanted to buy, say, I want to start buying bonds, we've created a support framework that actually helps you to access these investments. So we do have, for example, as first line, a contact center that you can actually reach out to and say, I want to actually engage someone who can advise me through the process of actually buying bonds. Yeah. So the contact center then puts you in touch with our advisory unit. Our advisors then will actually take you through the conversation of establishing what is your investment objectives, what is your risk tolerance and appetite, what kind of investments could actually fit in your investment journey. And as we do that evaluation, then eventually able to say, this is the type of investments that are appropriate for me. And once we decide these are the type of investments appropriate for the particular structure, then we go out and source for those investments for you. So we will enter into either a brokerage agreement, we'll enter into an investment management agreement, and based on those agreements, then we start executing the investment solutions that we seek to execute for your particular type of objectives. Okay. So anytime then you actually want to have those conversations, then we've created that framework so that we provide you advice on the right way to approach it and on the right platform to use for that investment.
Why does it sound to me like you guys are those BFFs that someone needs all the time? You're always there with solutions. Fantastic. Money Matters here, where we are creating wealth this Wednesday with NCBA Bank. As I say, go for it. Now, thank you so much, because I can see a question here, Paul. Someone is asking, I'm Pamela, tuned in from Homa Bay. What is the least amount needed to invest in bonds?
Great.
Yeah.
Thank you, Pamela, for your question. Yes, in terms of investing in bonds, there are different access points. If you're going to buy a bond directly from the government of Kenya, the lowest amount you can actually invest is 50,000 shillings. So with 50,000 shillings, you can buy a bond through your CDS account. If you're actually looking for indirect investments, as I was talking about, through the funds that we've created, you can actually start accessing a pool of bonds for as low as 1,000 shillings, really. Wow. So that it creates that much more access. And so it helps you to actually, if you're starting very low and you'll say, I want to build up, then you can start low through investing these kind of funds. And then as you do that build up, once you get to a particular level, then you can say, let me go and buy bonds directly. But the lowest ticket for the government of Kenya is actually 50,000 shillings. Okay. On the corporate end, if a corporate is issuing a bond, then they will always determine or prestate the kind of amount that you can actually use to access those bonds.
Great, great. I'm sure that answers Pamela's question. And, moving on, Paul, what are some of the benefits? Because even as someone comes in to invest at NCBA, they're looking for benefits. What are some of those benefits that NCBA offers to someone who is investing in bonds and equities?
Great. Great. I think maybe the most important benefit that you probably consider through coming through NCBA is actually professional advice. Okay. So you actually get a professional advisor who will actually advise you on the suitability of a bond investment. Okay. So that you're not going in it blind or not sure how then each particular investment you're looking at is actually aligned to your objectives. So once we sit with you and appreciate what your objective you're pursuing, then you're able to provide you the advice to tell you, then instead of going for a say 30 years bond, why don't you go for 5 years bond? And then in addition to that, then you get access. Access is because we are in the market on a continuous basis, then we are able to source, or we are meeting a lot of people selling bonds and a lot of people buying bonds. And so we get a variety of these instruments. And so even in terms of accessing markets, accessing investments that you could not access either to, then we actually provide you that access. Then by and large, you also provide relationship management so that you also get a dedicated investment advisor who can actually be helping you every time that you actually want to make a decision as far as investments are concerned. And then, of course, I talked about technology. Yes. As an enabler, you can actually use our technology platforms to actually access these investments.
Okay, yeah. Fantastic. And just on a question also from our audiences, good morning, kindly let him talk on the tax deductions on T-bills. Yeah.
Great. Good question too. So the way T-bills are structured in Kenya, all T-bills are short-term investments. So we have a 3 months T-bill, we have a 6 months treasury bill, and then we have a 1 year treasury bill. The way the government has structured the tax on treasury bills is that they are subjected to withholding tax at the rate of 15%.
Okay.
So if you're investing as an individual, the rate of return you get is actually net of the withholding tax. And by their nature, treasury bills are classified as discounted securities. So if you buy a treasury bill worth 10 million shillings, for example, and the rate of return is 10%, just to use an easier calculation, then what you'll be paying to the government of Kenya will be 900,000 plus if the return on the treasury bill is so let's say that again. If you bought 1 million shillings of a bond, and the return of it's say 10%. So the government will ask of you to pay 900,000 plus the withholding tax of 15% of the 100,000. So you probably be paying about 915,000. Then at the end of the 3 months or the 1 year period, then the government gives you back 1 million shillings. But all of them will be subject to 15% withholding tax. Of course, that's final tax for individual. If you're a company, then it's subjected to further tax. Yeah.
Oh wow, that answers Betty Wanjiru's question. Thank you, Betty, for that question. And Paul, just looking at, if we get into diversification, what is the importance of diversification between the bonds and equities? Yeah.
Good. So as you can imagine, then each of these investments, we're looking at equities, they present a set of risk and opportunities that you have to think about. As I said earlier, equities is a residue investment in a company.
Right.
And when you're buying equities and you're taking the risk that this company could go down or could go under, but you're also taking the risk that this company could pay dividends or not be able to pay dividends. And so you're looking at two types of returns for equities, dividend income and the potential capital appreciation coming from this. Now, by that, then what that tells you is that it is possible that you might be in a place where you're either earning dividends or not earning dividends, your shares are appreciating or not appreciating. And that presents a particular opportunity and risk set. Bonds, on the other hand, are supposed to give you this steady income that's coming every 6 months. Each of them has a role to play on your investment journey. Now, if you assess that your risk capacity or willingness is at a particular level, then you have to figure out then how do I want to combine these two assets so that I'm not taking too much of a risk that's of an equity nature, or I'm not going too conservative in the form of, for example, buying bonds for the purpose of interest income. Because as we know, interest income from bonds could be ranged from anywhere from say 10%. I think last year rose to about 18%. While the payoffs, for example, on equities, as much as they are risky, could be much higher. So the diversification then helps you decide, okay, I have decided this is how I want to calibrate the risk I'm taking, and this is the kind of return expectation that I have. And that's why then each of them or both of them actually have a role to play in a well thought out portfolio.
If you can speak to the concept of risk tolerance and how it affects the decision to invest in bonds and equities.
Good. So what's risk tolerance? Risk tolerance actually speaks to one's ability to actually, tolerate risk. And risk here you are saying, I bought with an objective to earn interest income and to access my money over a particular period of time. What is the risk that may not happen? So risk tolerance then is assessed in the form of am I able to take the risk I want to assume? And ability here is determined by so many things. It could be the money I'm investing. Is it the only money I have? Is this the last cent I have in my pocket? Because if it's the last cent I have in my pocket, then I have to keep my risks low. Do I have alternative sources of income? Because then if I have alternative sources of income, then I can assume more risk. How did I even create this wealth? Is this wealth created passively? Is it an inheritance? Or how am I actually earning this wealth? That determines in a great way your ability to take risk. Or am I using this money, for example, that is required for school fees next week? That reduces that much the ability to take risk. And then there's a willingness. Willingness is here, can I sleep at night? The last thing you want to do is to invest and you can't sleep at night, because every 2 minutes you're trying to figure out, could it go wrong, could it go right? So willingness is generally the emotional, cognitive thought of what if this went wrong? How can I survive it? And that's why you'll ask people, sometimes when we're onboarding, what would happen to you if your investment went down by 25%? And you're trying to assess someone's willingness to actually take that risk. Now, the reason we do that assessment is because eventually you have to decide if investor of a conservative nature, can they take moderate risk? Can they take high risk? If they can take high risk, then the recommendation, the investment you go for is actually informed by that. And then you can actually say, you know what, because this person has 20 years to realize this investment, they can actually take, so say, equity securities as part of investment, but moderate that risk, let's introduce some bit of bonds. If they are very conservative, we'll say, you know what, let's go for low risk investments, buy treasury bills, buy fixed deposits, put some bit of bonds, but if you want to take equity risk, then let's put it at a particular low level. So it's a very important determinant of an appropriate asset allocation for an investor.
We get to our social. Wow. Someone is saying, hi Sally, greetings to our teacher, Mr. Paul. Paul, now you've been great to our teacher now, yeah? Now that we have an expert on board, please help me understand. One, is it better to invest in bonds or equities? What exactly is class asset? Yeah, and what's the difference between a bond and a loan, given that both are paid with interest and on specific dates as per the agreement? So probably we go, which one is better to invest in first, between bonds and equities?
Good. Yeah, so the way to answer that question, which one is better to invest between bonds and equities, is that none of them is better than the other. I think it's an issue of what role are they playing in my portfolio? So that if you've decided that I want a portfolio that has both opportunity for capital appreciation and steady income over time, then both of them have a role to play. If you decide that all your concern is actually to get interest income coming through, then you'll actually be leaning towards bonds. And so, for example, if I'm talking to someone who's retiring next year, I'll be telling them your priority may not be so much of earning capital gains from equities. And so we'll say let's lean more towards bonds, because all you're looking for is actually income from that. If I'm talking to a young investor who's in their 20s and they are still working, then I'll be telling them, let's try to get a good mix of equities and bonds, so that over time you get the twin return of capital gains from the equities fund, the equities investments, and also getting consistent income from the bonds that you keep reinvesting, so that you can also compound your return over time. So they both have a role to play. It's actually a decision as to then what proportions you want to use them in your portfolio.
Then what exactly is class asset?
Sorry, I've used that term repeatedly, asset class. So asset class really is what we do is to bundle particular types of investments that have similar characteristics in classes. And so there's a class of assets that we'll call fixed income securities. These are securities that will pay you generally interest income over time, and they have lesser risk as far as price appreciation or depreciation is actually concerned. We have other assets we'll actually call risky assets, and say, for example, equities, which we are saying the main source of return for these is actually the capital appreciation that you're looking for. So the classification here is driven by the characteristics of the overriding characteristics of particular investments. And so you can say for this batch, we call them risky, the others we call them risky, and then in between, then you create a continuum based on the combination of the assets that you decide to use.
And I think that the last question was, what's the difference between a bond and a loan, given that both are paid with interest?
Good. Interesting question. So difference between a loan and a bond, and I'm looking at it from the investor perspective. If you look at it, a company can actually go to the bank to borrow a loan, and they'll be paying interest to the bank. The bank may structure that loan as we'll give you 1 million shillings, you'll pay it after 24 months, but you'll be paying interest every few months. The bond, we are saying you go to a range of investors and tell them, now bring in your money, I'll be paying you interest every 6 months. So from an investor perspective, there's actually no real difference between these structures so far as it's paying you interest as per contract. So if it tells you that I'll pay interest every 6 months, then it does that. The only difference is that a bond may be listed, for example, on the stock exchange, allowing you, for example, to exit that investment before it matures. But typically a loan may be contractual in nature, such that the only exit opportunities you may have is when that loan matures, if you're investing in a loan for opportunity. And I know it's a very relevant conversation, because there's a rise in private debt opportunities across the market, where people approach you and say, lend me 1 million shillings for my business. You are giving them a loan. But by and large, you only exit that loan when that loan matures. For a bond, you can actually take to the market and exit before the maturity.
Okay.
Yeah.
Is there an opportunity in NCBA, like you're investing in the bonds and equities, and you're able to and that is able to, you're able to link that to the international market? Is that possible at NCBA?
Yes. So I think, as I was stating on your starting, right now, for example, if I wanted to access a portfolio of international bonds, we already have a product called the NCBA Global Fixed Income Fund. And what it does, it actually accesses a very diversified pool of global bonds. So you'll, in this pool, you'll have US bonds, you'll have European bonds, you'll have African bonds, all brought in as one investment. If you have, for example, a quantity of money that you'll say actually want to access a particular market, then we can always, through our network, help you access those markets to buy a particular type of bond. If you're looking to buy equities, we also have a global equities fund that then allows you to access listed equities across the market through other funds that are listed out there. So, for example, right now you can access in that fund 60% of the US market, 13-15% of the Chinese market, and it's all that diversified. So then you, from the comfort of your desk in Kenya, then you can access the whole world global market.
Okay. Yeah. All right. So does NCBA then help also this client who's now in all this investment or bonds and market to just adjust probably and even monitor their portfolios in one way or the other?
Indeed, and that's an ongoing conversation. So what we do, if you're investing through us, and we meet you on a quarterly basis. The quarterly meeting is actually supposed to help check if you had said this is what you wanted to achieve, is the investment we bought still able to deliver the return you are looking for, or is the risk changing as far as that asset is concerned? So that at that quarter meeting, then we can actually recalibrate and say, you know what, we thought we were moving in this direction, but because the markets have shifted, then we probably need to change our sales so that we start moving in a different direction. And so you get a chance to say, let's rebalance this portfolio, let's look for these different types of assets. And that's why we then emphasize on those quarterly meetings, or at least frequent meetings with our customers, so that we're able to assess whether the objective of the investment is actually still being met.
Fantastic. Wow, that's super. So there's someone here, he's called Gicheru. He's saying, hi Sally and the trainer. I appreciate your engagement, very educative. My question is, what's your current yield on your equity fund and bond fund respectively? Do you have a balanced fund? If so, what's its current yield? Thanks, Jason from Kisumu. Yeah.
Thank you, Jason. Very good questions. So I think looking at your first question, what's your current yield on the equity fund and the bond fund? So in terms of the equity fund, what the way we've structured the equity fund is actually to track the performance of the Nairobi Securities Exchange. And so what I can do is to give you the performance we had on a full year basis last year. Last year, our return on the equity fund was 34%, against the return that the market reported, or about 28%. Our bond fund currently, or our fixed income fund, is returning at about 9.8% as of yesterday. Now, what you realize that interest rates have been coming low, very low in the market. I think if you looked at treasury bills, we've now gotten to the 8 to 9% range. So the returns on bond funds are actually tracking the general interest rate market. The other question was.
I think he asked about, so do you have a balanced fund? Yeah. So within NCB, we don't have a balanced fund, and I'm looking at balanced fund in the form of mixing equity securities and fixed income securities. But what we do is we create balanced funds on the basis of mixing the two investments. So if we came and we assess that you actually would require to have a fund that needs 60% equities and 40% bonds, we actually create that investment for you in a bespoke manner, so that it's actually reflective of the kind of investment posturing that you are looking for. So again, the yield will actually be a derivative of how we structure that portfolio. And for a client who wants to build wealth over, a long term, how then do you structure their portfolio in terms of investment?
Good.
Yeah.
So if you're looking to structure your portfolio in the long term, this is how we go about it. There are various considerations you have to make, or we make rather, when you're looking at long-term investments.
Right.
So it's about 7 or 8 factors that we look at. So first we look at your return objective. What exactly are you trying to achieve? Is it to save so that if your kids are in grade 1, that you'll have money to actually take them to university about 15 years? What is that objective that is so critical to you? Or is it your retirement that you're actually saving for? So then we assess what level of return would be appropriate to actually achieve that. Then we also look at your risk tolerance, what we were talking about earlier. So risk tolerance here, you're looking at how much risk can this portfolio tolerate based on how I understand this, understand the customer. We also look at your liquidity needs, so that even if you're talking about long term, we want to be cautious enough so that, because we know even the best laid out plan can actually change along the way. So can I provide for some bit of liquidity just in case something was happening?
Right.
So what is that level of liquidity that I must provide for in a portfolio? We also look at whether there's the tax implications of that investment. So if you're tax exempt, we'll structure your investment differently from a taxable investor. We'll look at the time horizon. Really, when you say long term, what are you talking about? Are you talking about 10 years, 5 years, 15 years? Because again, that can also be very relative to the investor. And then the other consideration, like any unique factors. I've had customers who come and tell me, do not invest in this type of entity because of their own beliefs. So I have to ensure that those unique factors are actually taken care of as actually making those investments. Now, when I put all those factors together, then I develop what we call an asset allocation. And we'll actually evaluate that this asset allocation is meeting that objective and can actually sustain meeting that objective over the investment horizon. And then together we move to executing that, and we consistently evaluate to ensure that it's staying within the parameters that we developed.
I know you've talked about retirement in the opening clip when we started the show. You've also mentioned it again. So can someone plan their retirement through investing in bonds and equities?
Indeed, indeed. You can actually you can use bonds and equities to plan for your retirement. Remember, the core objective of planning for retirement is to be able to replace your pre-retirement income through other sources. And most importantly, we always say, if you can replace that with passive income, passive income is one that doesn't require you to move at all to actually earn, then equities and bonds become a very good instrument. Now, the way I look at it is, the mix of bonds and equities that you want to use is determined a lot by the stage at which you're starting. If you're starting to plan for retirement very late in life, then if you say you're planning at 50, then you want to go conservative, and so bonds become a more plausible investment. If you're starting to plan for your retirement at the age of 20, then a mix of bonds and equities becomes even better. But all important is to ensure that over time you can see how that investment is growing, and that by the time you're getting to your retirement, you can actually have a pool of assets that you can invest in a way that they'll give you a consistent and steady source of income. We always advise on, for example, being able to derive up to maybe 60-70% of your pre-retirement income from your passive investments.
Paul, I think you're doing a great job here, because lots of questions coming in. Again, someone is saying, wait, I'm really learning. But still I have a question. Questions. Do bonds buy dividends? How do you make money in bonds other than interest, and does it pay monthly? Let's first go with the two, because they're like 4 questions. So do bonds pay dividends?
Bonds pay interest income, equities pay dividends. So bonds will tell you as you're starting, we're going to be paying interest at the rate of 10% per annum. That will not normally change unless you bought a category of bonds we call variable interest bonds. So those bonds will probably be adjusting their interest every 6 months, depending on the market. But generally, they'll pay interest income. Equities, on the other hand, pay dividend, which is determined either on a half-yearly basis or on a full-year basis. And you see each now and then, like this is a season where a lot of companies are declaring dividends, and those are determined on the basis of the overall performance of the company. On the second question, on how else you make money on bonds other than interest income. Now, again, it depends on how you're looking at it. There are 2 types of investors in bonds. There are people we call traders, and there are people we call investing for income. So if you're investing for income, the predominant source of income for you will actually be the interest income coming from these bonds. And these are people who will always say, I may hold this bond to maturity, because all I want is actually interest income coming from it. But a trader, on the other hand, will actually be trying to take advantage of the movement in the prices of the bonds in the market. So they will want to derive a lot of their income from the trading of on the price variations as far as the market is concerned.
Right.
Trading takes a bit of information, more information to actually really execute. And so it is a decision that one will have to make to actually decide what space do I want to play. Do I have the information? Am I present enough in the market to actually be able to take advantage of that opportunity?
Okay. Yeah. And very quickly, because of time, probably between bond and stocks, which is better, I think you've talked about that, then are there any risks in bond? Because so far it sounds like a good deal.
Yes. They certainly, I think there are risks in every investment. I don't think the concept of risk investment, I think, has been challenged in a big way. There are risks in bonds. I think I started by saying the most important consideration in a bond is actually the credit quality of the borrower. So if the borrower, for some reasons, then defaults, then your money actually, you lose your money. And so even when you're starting to invest in a bond, then ask yourself a big question. What is the likelihood that this borrower can, can default? The second risk is, especially for these bonds that are traded in the market, every time the market is moving, then bonds lose value or gain value. So then you could actually be holding onto a bond that you intend to sell next year, but then by the time you want to sell, the price of that bond has actually come down. And so that presents a risk that you always have to be conscious about. And that's why even in selecting the type of bonds you want to buy, you have to be quite conscious of what risk it presents. Very long-dated bonds present, a higher market risk or trading risk than actually short-dated bonds.
So what would be your advice, because you're the expert here, to an investor who wants to approach equity investments during a volatile market period?
For me, equity investments are an element of due diligence. Really, what are the fundamental considerations about the company I want to invest in? So in essence, saying I'm not investing because people are investing. I'm not following the herd. I'm actually doing some homework before I actually invest on any equity security. Volatile markets come and go. So you'll be in volatile markets. Then what you always to ensure if you're buying in a volatile market is that you're buying at the right price. So don't pay too expensive. Remember, equities investments are long-term play. They are not investments that you buy today and want to sell tomorrow. We always tell people, if you cannot hold it for 3-5 years or probably even longer, then probably it's not the right investment to actually go for, because you might buying it and then want to exit when the market is not right. So always do your due diligence on the company you're investing. And then always try to make sure that you're paying the right price, and that's the role that we play in the market in terms of advising our customers.
Fantastic. And on bonds again, what is the difference between on bonds, the coupon and then its yield when it comes to bonds?
A very important question, actually, and I know sometimes sometimes we get lost in the two. Now, when we talk about a coupon of a bond, this is the rate of return that was declared initially when the bond was issued. So when the government of Kenya, for example, issues a 10-year bond, they may tell us, we shall pay you interest at the rate of 13%. That never changes in the life of the bond. Your interest will always be computed on the basis of 13% of the value of the bond that you purchased. And then they will divide into two and pay every 6 months, they will pay you half of it. Now, yield, on the other hand, is determined by the market circumstances. So just to illustrate, for example, if I bought that bond at 13%, and then interest rates, the general interest rates in the market have actually come down, the demand for that bond in the market rises, because people are saying this bond is paying a rate of 13%, but the interest rates in the market have actually come down that much. So if, for example, the interest rates in the market have come down to 10%, people are willing to pay a premium on that bond. That premium is determined on the basis of the yield of the bond. And so we are saying, the yield of this bond could have actually come down to 10%, and so you are paying a premium on it. So it's a basis of deciding, am I going to pay a premium for this bond, or am I going to buy it at a discount? And it's all a balance of what is the initial interest rate that the bond is paying, and what is the current level of interest rates in the market.
Probably in like 30 seconds, maybe you can wrap up with your final, sentiments, advice to our audience.
Great. Thank you so much, and thank you so much, Sally, for having me. I think my parting shot for the audience is that, you know, we say the journey of investing starts now. I think I would be encouraging all of us to actually start the journey now.
Okay.
We are here to actually provide the advice and the comfort of information, so that even as you make these decisions, then you actually have the right information to make those decisions. I don't think there's no reason to fear investing in equities or fear investing in bonds. But just to assure you that we'll be on standby to actually help you should you reach out to us. Our contact number is 0756 0711 056 444. I will repeat that, 0711 056 444. You can reach out on our contact center, and then you will be routed accordingly should you be seeking any advice as far as investing in equities and bonds. But we'll be happy to actually start the journey with you or continue the journey with you by answering any questions you may have.
Fantastic.
Thank you so much.
That's a good way to end that. And indeed, if you are interested or you feel like you still have more questions for our NCBA expert here, Mr. Paul, then you can still send in your text, send in your questions on 20316, which is our SMS line, or 0786 316 316, which is still our WhatsApp line, and we'll be able to get those questions or concerns to the NCBA team, and they'll be able to reach out to you. But until then, we want to say thank you so much, Asante Sana, for your time, for the questions, for just engaging us this morning as we, NCBA helps you to create that wealth. NCBA helps you to plan your finances and personal goals and all that when it comes to matters finances. Asante Sana. And to also that very special group of people called our partners. These are people that really hold our hands. They walk with us through this journey to bring you such content, by supporting us in various ways. And if you feel you want to be part of this team, then you can send in the word partner to 0786 316 316 WhatsApp line, or 20316 our SMS line. Just send the word partner and we'll reach out to you. And if you want to be a blessing to this ministry, then you can also do that through our pay bill number 316 and send the word to the number, to your telephone number. That is your account number. Thank you so much. And remember, it is only NCBA that will get you there, will help you achieve your financial dreams. So NCBA, go for it. Thank you, and see you again next week.